And we realized that this completely dominated what we were doing before.
So I want to get started and learn more about your background. So when was it that you first got introduced to data and the value associated with it? Was it one of these snap aha moments where you're like, wow, this is really cool? Or was it a slow progression that intermixed with your broader career?
Yeah, so I started in quantitative investing about 15 years ago. So what was involved there was investigating particular signals, basically feature engineering. But instead of putting it into a sophisticated model, what you would do is you would sort stocks on that particular feature, and you would buy high values and either short or avoid low values, right? So if you shorted them, you'd call that a factor. It's a long short factor. And if you just kept a long only portfolio, you only bought stocks or whatever the asset is, you would call that smart beta. So features in this context might be return on equity. It might be earnings to price. It might be book to market. It might be momentum. These are just the sorts of features that tend to predict stock returns. So I spent a good part of my career and even life working on that aspect, feature engineering and very heuristic portfolio construction. It was only a few years back, and it was actually after I had moved firms. So I'd spent about 9+ years at a firm that did smart beta factor investing. And we actually spun off the Asia arm of that firm and started the firm that I'm currently at, Brilliant Global Advisors. And we started with a factor approach at first, but then moved into the more sophisticated machine learning approach, optimization approach. And it definitely wasn't an aha moment, but what happened was we realized that there were many more features than one could reasonably build heuristic portfolios on. That is, we had something like 100+ features that seemed to predict return at least somewhat well. And the question is, what do you do with that? How do you heuristically build a portfolio from that? Now, if one is utilizing machine learning, it's actually quite obvious what you do. You use those as features in a predictive model, and you predict return, and then you just have one thing there. You have expected return, and you can build an optimal portfolio from that, a mean variance optimal, mean tracking error optimal, whatever your risk measure is, you can build an optimal portfolio from that. And a couple years back, I had been watching various machine, or I should say data science YouTube channels, yours included, and reading various papers on data science and machine learning. And I realized that this is at least worth investigating. Now, there wasn't necessarily an aha moment, but there was a moment where we saw the results of the model, and we realized that this completely dominated what we were doing before. And we realized that we needed to migrate over. Though that was quite an investment of time to even realize, right? So you see a model and a method out there that's completely different from what you're applying right now. You have to invest a lot of effort to test it. And so it took us a few months to get to a stage where we said, look, this is better. We need to utilize this model. So not quite an aha moment, but when we saw those results, it was pretty clear what we had to do.
That's very interesting. You know, something that stuck out for me during what you just said there was how you described features. So I think features in finance are a little bit different than they might be in marketing or another domain. They're already transformed for the most part into some form of like KPI, a key performance indicator, right? So you have like price earnings ratio, which is a ratio of two other things. You have like whatever other metrics that are out there that I can't think of off the top of my head. But you're working with already generated like in theory, like very small models that you're analyzing already. And I actually think that in a lot of professions, those like KPIs or those other ratios of different things, they can get in the way of machine learning. It's like, oh, we have these already, they're reliable. What, why would we go any further? And I see that a lot in sports. They're just as prevalent as they are in finance. In baseball, you have batting average, you have you have wins above replacement, you have a bunch of these different things, which are relevant in sports analytics. But to go from those to the more sophisticated machine learning models, it is a little bit of a jump, and it's a completely different way of thinking. You kind of have to deconstruct the original tools that you're using, and you build something not completely different, but with more of the foundational building blocks. Thanks for watching this clip. Luckily for you, I picked 2 more clips that I think you might really enjoy. Either watch those or maybe check out the full episode.